Welcome back for the second time. Happy Tuesday. Good morning. It's going to be bonkers. It's actually already been bonkers. Thank you for joining me. Let me know if you guys can that the audio is okay. And I'm going to jump right into the housing market update. After the housing market update, we're going to watch 3 different videos from 3 different companies. After that, we're going to do our market analysis. That's the value I'm going to include. So definitely watch the market analysis, you guys. And then I'm going to end with Q&As. Thank you for rejoining me. Sorry about the first live, you guys. Something was wrong with the audio. If you guys can, let me know that the sound is okay. And I'm going to jump us right back into where we left off. We good? Okay, good. I really appreciate you guys. Let's continue. Now, this is where we were at, you guys. Obviously, the 10-year is still up today. It's been all over the place. When the markets opened, it did drop. Here's where we were sitting at as far as interest rates. We're at 7.48% right now. That is super high. I think that's a 21-year high. Last time it was that high, I believe, was April of 2002. Now, we looked at the interest. If you get a normal house right now, the loan amount would be about $336,000. You guys would be paying $122,000 in interest in just the first 5 years of home ownership. Not only that, we also looked at what would happen if we made $500 biweekly payments. We saw that if we do $500 biweekly payments, we can actually turn a 30-year loan into a 17-year loan, almost 18 years, 17 years, 11 months, and we would save about $250,000, you guys, $250,000 and interest. So we may want to start putting extra payments to our principal to pay that down faster. And that's where we were right there, you guys. So what I am going to try to do now is let's go back into the video. Okay. And if you guys can, let me know that the audio is okay. And again, from the bottom of my heart, I'm really sorry about that, guys. Enjoy. She's going to go into a lot of things, a lot of very interesting stuff. And really, I want to point out how hawkish she believes Jerome Powell is. Let me know that the audio is okay. Okay, guys?
Appreciate it. All right, folks. Now, of course, since the meeting in those minutes, we've heard from all the members of the FOMC, and they've had comments. And here's the thing. So Philly Fed President Harker, he says he's willing to pause. He wants to sort of prep even for rate cuts. But Fed Governor Michelle Bowman, well, she's still looking for more evidence of inflation. She's saying it's not tamed. So I want to bring in Danielle DiMartino booth. Danielle, so on Team Harker, we've got Philip Johnson, John Williams, and Austin Goolsbee. On Team Bowman, you've got Neil Kashkari, Lori Logan, Michael Barr, Lisa Cook, Christopher Waller, and a guy named Jay Powell. Who's going to win this battle?
Well, I think that Jay Powell is going to continue to win the battle into 2024. But at some point, you reach a critical mass of dissent. We already know that 2 would have dissented. I think 3 is kind of the big number for him. But I think he's fully prepared to withstand dissent because he wants to maintain that higher for longer stance.
But he's the most hawkish one in your opinion, though.
In my view, he is. I mean, he can't really come out, just saying that. But I really do think that this is his mission.
So we have some people I remember when they first started hiking, right? When the Fed started first hiking rates here and they went crazy like this, my question was like, when will they stop? The answer I got from a lot of folks is when Fed fund rates are higher than core inflation. We're there now.
We are.
Is that a signal then to at least pause?
We are technically running restrictive policy. So there is the signal to pause. But by the same token, the minutes stated that a lot of companies, despite higher interest rates, are having no problem servicing their debts. So that's the Fed's code for saying, financial conditions are still loose, people.
Right. Also, though, I forgot who put out the table. I wish I had it. A lot of that debt isn't, these companies are fixed pretty good. They don't need money for a long time.
Yeah, the maturity wall, so to speak, really doesn't become problematic until 24 and 25. Not the same thing with commercial real estate, which is that it's currently refinancing. Right. But for corporations, they've got some time.
Lauren mentioned consumer credit, the credit crunch. Mm-hmm. So look at this. This is the New York Fed, that senior lending officer survey. We have never seen a spike this sharp in terms of how quickly they tighten their lending standards. And yet still, that crunch doesn't feel like it's upon us.
I think the crunch is there for people looking for credit that don't necessarily have the best credit. In fact, another New York Fed survey found that rejection rates in the next 12 months are poised to be higher than they've ever been in history, as the minute said, across credit cards, autos, and housing. So we're there, and lenders are preparing to tighten up even more.
I do hear from businesses more than I do from the data that they're ready. Like, we heard from Target, almost every company that's reporting in the last 2 quarters are bracing for something that's still not in the data yet. I want to switch gears a little bit. The first anniversary of the Inflation Reduction Act. So we have this piece from Danielle, and as I'm reading it, it feels like, I hate to say it, but it feels like it's from Pravda. It's like,
oh, it was awful. It was the word that I used on Twitter yesterday, and I didn't use it lightly, was un-American. I mean, this is not what we're about. We're not about encouraging unprofitable enterprise. I don't think that was what the founding fathers envisioned. And yet we know that Ford and other companies are losing money on these initiatives. Yeah. They're taking the government's money, but it doesn't mean that they're profitable initiatives. And I don't applaud her message.
Yeah. And, you know, this notion of a battery belt bothers me because all the materials come from China. They control this whole thing.
Yeah, got lithium.
Yeah, exactly. Lithium, cobalt. And that, by the way, there's a limited supply of that as well. I can't let you go without asking the biggest question of them all. All right, right now, government spending is surging again, right? Surging. Meanwhile, receipts are plunging. This is a crazy equation. How long can we live with this equation?
Apparently, we can live with it for a very long time. Look, come October, when California has to pay its taxes, some of this is going to be corrected because California is the most populous state in the nation, and they had a long time to pay their income taxes. So that is partially an aberration. But the other part is that Uncle Sam is spending like a drunken sailor. The employee retention credit pumped more than $30 billion into the economy in the month of July alone. That's a $400 billion annual run rate. Uncle Sam's still giving money away.
Right.
So until that ends, and until it's efficient and prosperous and leading to long-term prosperity,
and inflation can never truly get to a target.
Sorry, this gets me really riled up.
Can inflation ever get to a 2% target with this kind of imbalance?
Well, it's difficult to get all the way down to 2% if you're spending without really caring about how you're spending it or how efficiently you're spending it.
Right.
And that's how our government's spending.
Great stuff, Danielle. I mean, the message is tough, but it's honest. I appreciate it so much. But still to come, my takeaway on the affordability, I'm going to give millennials.
So good stuff. Let me know what you guys think about that video. I love that video. I love listening to her. I find it intriguing that she's saying that Jerome Powell is hawkish, right? And I understand the reasons, and it's very intriguing to me. And also, I like that she pointed out the massive influx of credit tightening. Credit tightening is exactly what we need, especially if the increased interest rates are breaking other parts of the economy. So obviously, why is the Federal Reserve doing this? Why is all of this going on? Essentially, because we need to slow down inflation, right? I would say we need to deflate the housing market because essentially here's the problem, you guys. The average American cannot come close to purchasing a house, a normal house. The average American is so far away from being able to afford a house. What I see in front of me, you guys, after 22 years in real estate, I have no explanation of this market. This market is so toxic and so dangerous. It's like, I'm almost at a loss for words. So I'm really hoping you guys are starting to see like, hey, the government's doing stuff, right, to the economy and to the housing market. And generally when that's going on, we want to be very careful, right? We want to be very careful. And that's why we're going to go into the market analysis towards the end of this. But let me show you guys something that I found this morning, which is the reverse repo market. This went up again. So we were watching this day over day. So it updated yesterday. It went up. It's crazy that this is going up. Look at the trajectory of the reverse repo market. I mean, it was plummeting. And then we hit July 20th and it's been going up, which means the money is not leaving the reverse repo market and they're not purchasing treasuries. They're keeping their money here and liquid. And basically this money represents the bank's money, deposits, money market accounts and things like that. So they park the money here for 1 day. And I believe the yield, the annual yield, I think is 5.3%. Again, you guys, this is kind of where the US got the money to spend. All right. Well, this is some of the places that the government got money to spend. But again, it's going up again. So what I suspect, the reason why I'm pointing this out to you guys is this, I believe, is going to be an additional factor that will continue to increase interest rates throughout this year. And essentially what I'm saying exactly, y'all, is the interest rate is going to go higher. Interest rate is going to go higher. We pretty much know that, right? I think that we're going to have average interest rates in the 8% this year. It's possible that for a brief moment that some people get 9% for a brief moment. But the next video I want to go into, you guys, is a nice breakdown basically of the timeline of the Federal Reserve. Essentially, they're going to go into the fact that we have to have rates higher for longer. If we don't, runaway inflation. Inflation comes back, especially in the housing market. The housing market is an absolute disaster right now. It's changing, but it's still a disaster. Let's go into our next video right now. And if you guys can let me know that the audio is okay, I will appreciate it. You guys enjoy.
Now for a look at the potential market catalysts in the week ahead, Lindsay Piegza, Stifel Chief Economist, and Karen Kavanaugh, Carolina's Wealth Management Chief Investment Officer. Lindsay, let me start with you. Why don't you tell us your expectation for Jackson Hole in the Fed Chairman's speech on Friday?
Well, I think a lot of the conversation is going to be around inflation. You talked earlier about the Fed not wanting to declare victory, and in part that's because they haven't reached their 2% goal. Now, the Fed has made tremendous progress restraining price pressures off of earlier peaks, but the intention was not to get inflation down from 8% to 4%, but to continue on this downward trajectory to that 2% target. So I do think that the Fed has, again, reason to be confident that they're continuing to make improvements. But as we saw in the July FOMC minutes, even before the latest hotter than expected inflation numbers, there was still seen a significant upside risk to inflation. And so I do think that the chairman is going to emphasize the need for more work to be done and potentially resulting then in a higher for longer rate scenario.
Karen, is this an event as far as the stock market is concerned? Is it just sort of, is there only downside risk to the chairman talking here? Is there the idea that he's going to end up being hawkish and that's not going to be positive for the stock market?
I don't think it's that much of an event. It's not like it was last year where we were really looking for some guidance from Chair Powell. So this year, I think it's going to be a little bit more subdued. We are looking for Powell to really give us some guidance on how he thinks progress is working out with our fight against inflation. But I don't think that it's going to be as groundbreaking as it was last year. I think the market already knows that we still have a little ways to go in inflation. We've had stronger than normal economic data as of late. So I think the Fed chairman is only going to say what we already know.
Karen, are you advising clients that the Fed is going to stick the landing here, that it's going to come off that balance beam, it's going to be standing up, put its arms in the air, and get tens across the board here? Or are you more worried? Are you concerned like Joe is about the end here?
Well, I am concerned because it's not easy to stick that landing as you were discussing. So, but I think that even if we do see a recession, it is not going to be severe. We do have some buffers. So we may see a mild recession. It's not off the table yet, but I think it's very difficult to kind of thread that needle and have a totally soft landing. We know that monetary policy has a 2-year lag, so we haven't seen all of the effects of what's going on with raising interest rates so much so soon, so quickly. So therefore, I'm cautiously optimistic.
Lindsay, I want to ask the same question of you, but I want to make it a little more economically geeky, perhaps. What does the Fed do with this idea that it brought down inflation by as much as it has since Jackson Hole last year? Unemployment has been flat, and GDP so far, this quarter, it's kind of running kind of crazy. And the last several quarters, it's been above trend. That has not comported with their forecast or their view of how the economy should work.
No, it certainly hasn't. And I think they underestimated a number of the artificial or superficial supports that were deployed during this unprecedented time, during the pandemic and in the immediate aftermath, that continue to artificially support the consumer and by extension, the broader economy. And so I do think that the Fed has underestimated the timeline needed in order to see the intended effects of tighter monetary policy. But that doesn't mean that weakness has been entirely deterred. It simply means that it's been deferred. There was an expectation that weakness would have come into play early 2023. That's pushed out to late 2023. Now 2024 is the expectation for that downturn. But that doesn't change the Fed's focus and the intention of tighter monetary policy, which is to raise rates, tap down investment, tap down consumption, and by extension, then eventually see that slowdown in top line growth, resulting in more benign inflation. So the Fed has been able to achieve a good portion of their intention, again, getting us down from 8% to 4%. But in order to reach that last 200 basis points, getting us back to that 2% target, the Fed will have to eventually tighten enough, reach that sufficiently restrictive level in policy to slow growth enough in order to see that more benign price level. So again, we're eventually going to see that downturn. We've just pushed that out further into the future.
All right, guys. So that is that video. Let me know what you think about that. I'm going to queue up our third one, but I mean, I think she has some really good points. And being that, I mean, what is she doing special? She's just listening to Jerome Powell. Jerome Powell, remember you guys, March of this year, what, 4 or 5 months ago, he went and testified in Congress and specifically said higher for longer. So this shouldn't be a surprise, but it's refreshing to hear these people starting to accept that. Now, let me show you what the market is doing as far as, are they pricing it in? Are they not pricing it in? We're going to go to the CME Fed Watch tool. Now, this has changed as well. This is actually pretty cool. Let me refresh it, see if it's changed anymore this morning since I had to restart this. Oh, it has changed. Wow. All right, so here's the market basically for September. This has gone up. This is actually 50% higher than what it was. Still not really pricing in a rate increase September, but it's definitely higher than it was. It's sitting at 15.5% of a 25 basis point rate hike. But let me show you guys November and December, because there has been huge movements in both November and December. Now, when I actually accessed this morning before the live, this was at 40%. So right now it's at 37.7%, which basically means rate hike, 37% chance in November. So the market is kind of starting to price in additional rate hikes. But look at December, you guys. It's about the same as November. Let me move my picture. I'm sorry. Is at about the same as November at 36.5%. But what I also want to show you guys is July. Now, I'm hoping we can make it all the way to July. So basically, here's what the market is saying about July. Pretty much the market's saying we're pretty sure, almost guaranteeing that there's going to be some type of rate cuts by July. And you guys can see this here. Now, this is where we're sitting right here. We're sitting at 525 to 550. So to the left of this represents rate cuts, right? The first one, 25, 50, 75, 100. Obviously, this will change if any activity with interest rates change. But if you're wondering when the rate cuts will begin, probably at the end of the sometime at the end of the second quarter. Hopefully we make it that long. That would be really good. The longer that we can make it, the better. Let me show you guys something else that's really crazy. The 5-year break even keeps going. It went up again. So much craziness is happening right now. On one hand, we got some stuff falling apart, crippled, especially commercial, certain financing sectors. We've already had bank runs. But yet inflation is still out of control. We see that. Members of the channel, subscribers to this channel see that because we monitor the housing market. We want to find housing that's affordable for the average American. This is showing that they got more work to do. This is showing that they need to go higher. The market's expectation of inflation is at 2.25%. Other than the CME Fed Watch tool, this is something else we can watch to determine when the rate cuts are coming. This needs to drop down probably to under 2%. I'm not sure how much under 2%, but it needs to go under 2%. And it's been going in the opposite direction since June. Okay, so you guys can see it dipped down to 2.07 June 1st, and it's been going up pretty much ever since that. To me, I find that very intriguing. I'm not sure if you guys find it intriguing. I find it intriguing because we got like the tale of two cities going on right now. So what we're going to do now, guys, is we're going to go into our third video from Bloomberg. So we're adding Bloomberg into this as well. And this is going to go into the fact that the recession is only delayed. It's not canceled. And you guys that are watching probably agree. So I'm going to play this one. You guys let me know that the audio is okay. And I hope you guys enjoy.
China. I'm sure you're watching this very closely. Are you concerned about contagion risk, and do you consider China to be investable right now?
We are concerned about contagion risk, and really I think what we're having to adapt to is a new world where we can no longer count on China being the counter-cyclical force to some of the more developed markets. Right? Earlier in the show, you talked about fighting a slowdown with just additional debt. And that's what we've been doing here for the last over a decade and a half. And now it's really starting to come to bear. The consumer can't support that increased debt stock. Governments around the world can't support that increased debt stock. And we are worried about that contagion because China is slowing, but it's slowing along with the entirety of the rest of the world on the back of higher rates and just that constant pulling forward of demand.
So we've seen the government take a few measures to try and stabilize this situation, but is it enough? And what more needs to be done, in your view?
Yeah, right now it isn't enough. And I think the most interesting part to be watching as many of those Chinese officials come back from their secret retreat to see what they do roll out. But China's in a tough spot because one of the traditional measures would be that it weakens its currency. But of course, on the back of trying to insert it into one of the large global reserve currencies of the world, I think China will be reluctant to significantly continue weakening its currency. So we'll have to watch and wait, but I really don't think there's much they can do. And I don't think there's much a lot of governments around the world can do. We're simply having to pay for all of that pull forward of demand that we've had on the back of low rates and easy fiscal and monetary policies.
Jeff, you manage two huge global bond funds, and China Inc. is obviously issuing a lot less bonds, a lot less fixed income in the universe these days. Would you be interested in China fixed income at all, or are you concerned there might be a crisis in the waiting?
I think it's less about a crisis from the bond perspective, but it would be a little bit more of a crisis from the currency perspective. As I mentioned, I don't expect to see China significantly weaken its currency, but it's something that as global bond investors, we would have to watch very carefully. Now, of course, on the back of that, China used to be the country with notably higher rates relative to the rest of the world, and that just simply isn't true today. It's relatively easy to get 4, 5, or even 6% in many global markets in very high quality bonds. So for us as global bond investors today, we're focusing on safety and playing not so much in China, but more the U.S. and parts of the Eurozone.
So explain to us how you could see returns disappear from the government bond market universe, because that's literally what happened in the last month. And many, not just yourselves, but many houses are doubling down on this idea that there is a recession coming and that this is not the wrong trade. Explain that to us.
Yeah, I mean, we've been saying for quite some time, the recession is delayed, it's not canceled. As we watch all of the incoming economic data, and if we were to rewind the clock, thus far, the recession is playing out almost exactly as we would expect, with the consumer slowing, right? We see sentiment broadly deteriorating. We see loan conditions tightening. Now, it hasn't led to that precipice, that cliff of an outright recession. So it is delayed, but it's happening in lockstep to what we would expect. So it has been a surprise on the back of all of this to see government bond yields continue to rise. But I think we've been talking about this for quite some time. The world is expecting an immediate pivot once we see weakness, and we're just not going to get it this time around because we're emerging from a very low inflationary environment back to the more normal state of the world, which is a sustained higher inflationary environment.
So we do have a situation where rates are elevated. You can get a really good return on cash. So why take a risk? What's your cash allocation right now?
Our cash allocation is a little bit higher today, but one of the things that we're telling investors is now is the time to lock in safety. So yes, 5.5% money market funds are tremendously interesting, but we have to remind ourselves, it's relatively easy to get that 6 or even 7% yield in high quality fixed income. And it's that part of the portfolio that will actually go up if we do get that recession. So what we're telling investors is to move into high quality fixed income today and leave a little bit of cash for being more opportunistic in some areas of equities if and when we do get that recession.
All right, guys, let me know. I mean, you guys, I'm pretty sure you're noticing what I'm noticing. Over the last, what would you say, maybe 2-3 weeks, we've noticed, I've noticed anyways, I'm pretty sure you have, that it's becoming a lot more bearish in the market. They're now acknowledging what we've been looking at this entire time. I think that the media was able to blind and the suits were able to blind so many people because of the home buying season. Literally, the housing market affects the entire economy. If it wasn't for that very toxic home buying and that whole sentiment that it's still okay to buy, houses are just going to go up, buy now before it's too late, it's going to catch up with all of these people. It's going to catch up, you guys. I'm not everyone, okay, but there's going to be a large number of recent buyers who did not properly purchase real estate with the right expectations. I know that it's happened to me. I've been doing this for over 20 years. I see it happen all the time with consumers. They purchase, real estate based off of obsession. And that's really, really unfortunate to see that. And I've never seen it as bad as it is right now. But let me know if you guys think the recession is canceled. I don't think the recession is canceled. In fact, I think it's going to be here sooner rather than later. Let me show you guys the 10 and the 2-year inversion right now. This is the 10-year Treasury versus the 2-year Treasury. Now, obviously, this is still inverted, but I wanted to point out the trajectory. Look at the trajectory, you guys. This is it's pretty much kind of skyrocketing upward. Do y'all see that? So what this is representing basically is normally when this uninverts, normally the last few recessions, we go into recession. However, it's possible that it's actually possible we're in recession right now, because it's okay, even if this doesn't uninvert, which it probably will before we enter recession. But even if it doesn't uninvert, we could still go into recession. But basically, I don't know that we're, it just depends on your definition of recession. I mean, the economy is all messed up right now. I think let me say this, you guys, I think there's more pain to come. Okay, as when the recession is going to start, I'm not 100% sure, but I definitely think there's more pain to come. I think that's pretty much a guarantee. So what I'm going to do now, guys, is we're going to talk about the market analysis, okay? So let me show you what we're going to do as far as that part of this video. This is one of my favorite things to do. I'm going to show you guys basically what we're going to be filling out is this form right here. This is something that can be easily done, especially if you have the help of a realtor, okay? So we'll be filling that form out here, basically getting, cash flow and wedge. Pretty simple stuff, right? So in order to do that, guys, I'm going to take you to the matrix, okay? Now the matrix is something that licensed agents can use to analyze sold property. The reason why it's really important to analyze sold property is basically that's how value is generated. In order to even come up with an appraisal value, we have to have sold property. So appraisals are based on sold properties. Okay, so what I'm going to do, you guys, is I'm going to change my picture to this. All right, and we're going to fill this out together. Maybe I should do it like this. I'm not sure. Actually, I'll do it like this. Okay, now hopefully my internet is not bad. I see my internet may be a little bit messed up here, but what I'm going to do is remember the very first thing that we need, y'all, is we need to pick a subdivision. Okay, so the subdivision I'm going to pick is Tavola. All right, so we're going to go with Tavola. And what I'm going to do is I'm going to go back here and I'm going to write in the subdivision on top. All right, so I'll put in the subdivision of Tavola because that's what we're going to do our market analysis of. All right, so again, we're going to go back into the matrix. We're going to start filling this out. We're going to see if we can find a house right now where we can cash flow and where we can have a wedge. These things are extremely important and normally not something that someone would do when purchasing a primary residence. But the more that we purchase our primary residence like an investment property, the safer that we will be going through a recession, going through turmoil and headwinds and things like that. All right. So we're going to go, hopefully that makes sense. So we're going to go back into this right now. All right. So I've put Tavola right here. So we need to get data from Tavola. We need to figure out the average rent and the average price per square foot, again, specific to the Tavola community. Now, in order to do that, I'm going to go and review sold property. I'm going to unselect active. And all I'm going to do this time around is look at the last year of sold property. Okay, so again, I have Tavola in here. I'm only looking at sold property over the last 360 days or the last year. Now, I'm going to show you guys the results. Okay, this is crazy. In 1 year, Tavola has sold 583 houses in 1 year. This is only one subdivision. That's shocking to me. So remember what we do next is we got to analyze all of this data. In order to analyze all of this data, we have to select it all. We have to go to stats very simply down here and then hit tabular, and this will automatically generate the data that we need to figure out if we're getting a good deal. So I want to point out where we're at as far as average and median. So here's average and here's median, and look at how close that is. In a normal market, average and median should be the same. But what do we see right here, you guys? Okay, so we have our first set of data, which is $143.67. So I go back here and I put $143, okay, $143.68. That's how much houses we're selling for on average over the last year per square foot. Okay, so we have that. That was super easy. Now I'm going to empower myself to try to, that's how we figure out wedge. Okay, so we need that to figure out wedge. Now we got to figure out cash flow. So I'm going to basically do the exact same thing. Only what I'm going to do is I'm going to exit out of here. I'm going to go into rental matrix. So I'm going to go into the rental matrix now and see how it's almost exactly the same. Always hyper local. Remember, real estate's about hyper local. I'm going to put Tovola in here because that's the subdivision. And again, this is the rental. So I'm going to go all sold properties over the last year. Specific to Tovola, let's see what the results are. 90. So 90 homes have been rented in the last year in Tovola. And remember, we have to select all of the data. We have to go to stats. We have to go to tabular. And this is going to give us our rent. So the average home rented for $1.11 per square foot. Okay, so what I'm going to do is I'm going to go back here, and right here I'm going to put, for average rent, I'm going to put $1.11 per square foot. Now, that information, you guys, is extremely important. With those two pieces of information, I can essentially calculate now my cash flow and my wedge. And I think that took about 5 minutes. Now what I'm going to do is I'm going to go back over here and I'm going to reset this. We're going to go to quick search again. Let me pull this up for you guys. And I'm going to just share my entire screen, not my picture. Okay, so we're back into the matrix. This is what we do. We put the subdivision of Tovola. And now we're going to look at the active listings. This is very important. So now I have active listings checked in Tovola. There's currently, let's see, 52 homes for sale right now in Tovola. My next step is categorizing this by price per square foot. And look at what we have found, okay? When I first looked at this, you guys, I was blown away. The very first house fits the median average, like the square foot. This first house, you guys, I may go after this video and go buy this house. I'm not joking. This is crazy. But anyways, this house is selling for $119 a square foot. We know the average square foot is $143. That means that's about 20% under market value. So let me click this and let's take a look at what this house looks like, okay? So we know that there's a price cut right here. Here's the square footage, 2,229. So what I'm going to do now, you guys, is I'm going to go back to my form, okay? And I'm going to start filling it out. All right. So we're going to go now to the price. Okay. Now that we have it, which is $267. I'm sorry, $267,000. Okay. That's the price. The square footage of the house is 2,229 square feet. I've already calculated let me show you guys. I've already calculated the taxes. You have to do it a special way, you guys, when it's a new build because it's not properly assessed. But the tax rate is a whopping 3.37%. So what you want to do is you basically take the sales price of $267 times 80% times the tax rate, which was, what was that again? Where's the tax rate? 3.37. So we'll multiply that times 0.0337. And this is going to be scary when you see how much taxes are here, you guys. $7,198. And I hope you guys can just rewatch this, right? All of the information is there. So now I'm going to put in my tax right here. I'm going to put a year, $7,198. And I also want to point out, here's my current rent. So hopefully my mortgage will be less than my rent, right? That's what we're going to try to do. Now, here's what we have to do now, all right? So now what we're going to do, now that we have this information, okay, again, we found a house, found the cheapest house price per square foot in Tovola. So now that I have the price per square foot for my house, I'm going to start doing some calculations. And then I'm going to also take you guys to the mortgage calculator and show you a roundabout way to calculate the mortgage payment on your own. But let's go back into this form so I can start doing some of these numbers. Now, where it comes to market value, you guys, all I do for market value is I take the square footage right here. This is everything right here. Okay, the square footage of the house. Okay, that's why we need this number and this number, because we multiply those numbers by the square footage. Okay, and then we get market value and we get market rent. Okay, so I'm going to do the first one, which is $143.68, which is price per square foot average. I'm going to multiply that, y'all, by the 2,227 square feet, which gives me, okay, you guys ready for this? How much you guys think it is? Okay, so the market value based on this calculations is $319,975. Okay, you can already see you would be walking in with equity. It's important you all understand that. Now we're going to do the same thing with rent. I'm going to take that 2,227 square feet and I'm going to multiply it by the $1.11 for rent. Now that gives me market rent, okay, of $2,471. Okay, do y'all see that? Now I can start figuring out my cash flow and my wedge. But first, we're going to figure out the payment, obviously. So in order to do that, let me switch over here and we're going to set this up. In fact, I've already set this up because I didn't want to waste your time. I'm going to throw this on the screen right now. So here's our payment calculator. Let me show you how I did this. I'm a loan officer, so this is really easy for me. All I did, you guys, is I put the home price right here. Okay, 267. I put only a 10% down payment because y'all know I'm doing basically 10% down payment. And normally, you guys, I would pay all of the PMI up front, which is down here, which would be probably another $5,000, $6,000 in closing costs. Okay, so I'm going to remove this out of here. All right, because I would pay that up front. And look at where we're at. Okay, so now first of all, remember, Tavola is predominantly Lennar. Lennar is offering right now, you guys, a 4.25% interest rate on select homes. So let's put a 4.25 in here. Okay. So that's our payment right there. This would be our payment if we put 10% down and pay the PMI up front and we get a 4.25% interest rate. Do y'all follow me on that? So I'm going to go back here. All right. And hopefully this video is not lagging. And I'm going to put my payment that I just calculated right here. 1,000. That's crazy, right? $882. Is that crazy or what? Is that really the payment? Let me just check one more time that that's the payment. Dang, that is the payment. Okay, that's super low. Now it's time to calculate cash flow and it's time to calculate wedge. In order for me to calculate cash flow, all I have to do is take the market rent right here and subtract the payment right here. Very easy to do. So again, I'm going to take $2,471. I'm going to subtract $1,882 and I have my cash flow. My cash flow, you guys, this is a good one, $589 a month. That's a decent cash flow. Now, in order to find my wedge, all I have to do to find my wedge is I take the market value right here and I subtract the purchase price right here. So that would be $319,975. Subtracting the purchase price of $267 would give me total wedge. This is so cool. I love doing this with you guys. Of $52,975. And if you want to see that again, just rewind the video. You guys, that took me 12 minutes according to this clock. So in 12 minutes, we did a market analysis. Okay, now let me bring this up again because actually maybe I'll go look at this house, but look at this. You guys, I'm paying rent, right? And this is what I'm paying in rent. Okay, I'm paying $2,400 in rent. My mortgage payment would be $1,882. So I would be paying over $500 less in rent. If I go buy that house, I'm paying $500 less in rent. If I ever converted it to a rental, I could probably make $500-$600 in cash flow. After minusing management fees would be less than that, but several $100s. And then if home value goes down, I have $52,000 in wedge. So even if values drop 15%, I should be okay. All right. So that's how that works, you guys. I really hope you enjoyed that. Did that as fast as I can. We are going to go and move on to the Q&As now. I almost messed up and didn't do that. Do you guys like the market analysis? I'm going to give you guys value I'm going to try to give you guys value every single live we do. It's hard for me to do that in my main videos because it's so algorithm sensitive. But again, you watch my live videos, I'm going to give you some value. You're going to leave my lives better than when you came. All right. Now, a couple of the comments. I'm going to start with Jeff. Jeff was like, massive run up and housing is coming. I gotta drink some energy drink for this one. With these lockdowns, when these lockdowns start and the balance sheet balloons again, you guys, I gotta be careful what videos that I make, but what he's referring to, I can't remember. Johnny texted me. Let me see real quick. Let me see what it is. Johnny just texted me the area. Where was it, Johnny? Where was it? Atlanta. Atlanta College is basically saying there's another outbreak, some type of outbreak, and they're doing mandatory masks. And I will say, if we go into lockdown again, it's gonna be real bad. It's gonna be real bad for everyone. We do not want to go into lockdown. But guess what's right around the corner? The election. Maybe it's coincidence, but geez, again, lockdowns, election, holy smokes. Next comment by J.O. This is why Jerome Powell has no choice but to break the economy. They can't afford the interest, and they also can't afford the inflation. The only way out is breaking it. And what he's referring to, I believe, is the amount of debt that the U.S. has to service. We know that the U.S. is in a tremendous amount of debt. They're paying, I think, something like, and maybe you can say, Joe, I think they're paying $500 billion a month or $500 billion per month in just their debt interest. So it's not even paying the debt down. It's just the interest obligation. So, but it's working so far. As long as they stay in that elevated level, we'll be okay. And here's Robert. He's basically saying the same thing. Lockdown's coming with presidential election in 2024. Nothing would surprise me. Super scary. That is very scary. Have you looked at Case Shiller? I actually, when you commented, I hopped on and I did look at Case Shiller. Problem with Case Shiller, man, and I like Case Shiller because it calculates value in an effective way, but it's lagging like crazy. So I think they only have May out right now, and we're almost towards the end of August. So it's very laggy, but it is a good way to determine value. Here's a comment from Ricardo. Ricardo is saying China has been uninvestable for years. The signs have been there for years before COVID, but everyone was stuck in denial. So I haven't done any videos about China yet, you guys, but China is in really, really bad shape specifically when it comes to the housing market. They're in bad shape. Basically, the reign of China may be over, which is not bad. And look this is from Don't Move. I haven't looked at this, so I'm not sure, but holy smokes, you guys, think about it. 21% unemployment rate in China for citizens between 8 and 29. Again, I haven't looked at it, but that to me, that is so scary. That is so scary. Poor kids. All right, another one from Dean. So he's basically saying that move over China. Mexico is going to be our number one trade partner. They're right next door. Why not, right? And then the last comment, you guys, from Jackie. By what fake inflation numbers my two sons had to combine both incomes and live together just to pay bills, a nurse and a physical therapist, income to break even in one household. And the reason I wanted to bring that up, guys, is just to remind everyone like why we're doing what we're doing right now. The average American cannot afford a house. If we go into lockdowns, I don't know what that looks like. But I will tell you, if we go into lockdowns and they drop interest rates, it's not going to be good. It's not going to be good at all. And we may have to go through this whole thing over again. And I really hope that's not going to happen. But I will stay on top of it. I will stay in this hot seat for you guys and bring that to your attention. And if you guys can, one more time, I like the video. I'm going to get out of here, you guys. I'm going to go try to do a boots on the ground video at a new construction. Don't forget to watch that video. Any boots on the ground video, you guys, please watch it. I put a lot of effort into that. But either way, you guys understand you are important and so are your decisions. And I have, basically, you guys, what I'm trying to say is relax, love yourself, love your life, empower yourself by understanding the data, research your local housing market, and do not purchase real estate based on emotions. I definitely appreciate you guys. I'm starting to respond to my emails. I got some exciting announcements to make. I will make those in the near future, but I'm responding to my emails. In fact, when I'm done with this recording, I'm going to respond to all my emails, catch up, and then I'm going to go do a boots on the ground video. I absolutely love you guys. Thank you for joining me. I hope you guys got value from today's video. And if you're out there investing in real estate, I wish you luck and I hope you win.